Good evening, everyone. Thank you for joining us for tonight's virtual session, Money Matters, Tips and Tricks to Managing Your Finances as an Expat in the UK. My name is Todd Shelley. I work with the University of California Trust, and I'm thrilled to be presenting our colleagues from Maseko tonight. So I will turn over the floor to Daniel Keeley and Oliver Swettenham, who will be walking us through everything we need to know about managing our finances. Over to you guys.
There we are. Sorry, guys, I wasn't able to get my microphone working there, neither with the camera. So I thought maybe best to start with that for sure. Um, well, good evening, everybody, and thank you for the kind introduction there, Todd. As Todd just explained, my name is Dan Keeley, and I'm a wealth manager at Maseko Private Wealth. And I just want to start by saying thank you. Thank you to Todd, thank you to Greta, and the rest of the UCT team for inviting us here today to really, as you can see in the title, to start to unpick some of the tips and tricks for managing your finances as an expat in the UK. Let me just move on to the next slide. Before we kick things off, I think it'd be useful to just give you a bit of an overview about the team that works here at Maseko, but also our relationship with UCT Trust. It all started back in the summer when we were honoured to be asked to actually help partner with your gala. And since then, we've actually been looking at ways to try and partner, to try and provide informations, do events, and things like that to cater to your community, the US expat here in the UK. Um, on today's call, as Todd explained, is myself, Dan Keeley, see there. Um, George is not with us today, but you may have seen him, whether that's through the sort of the advertising that Todd's done, or you may have seen us recently at the alumni Big Ten event. Of course, the University of UCLA now included in that prestigious bunch. We were there helping with the first event in the UK, so you may have seen George there as well today. But really, what we wanted to try and cover today is firstly just a very, very brief introduction to Maseko, so you can understand who it is that you're actually listening to today, the services that we provide to our clients, and how that uh, potentially may help someone's in your situation. We will look at some of the challenges of being a US taxpayer. Now, I'm sure many of you are painfully aware of the reporting obligations, the tax landmines that one can step on when you're trying to manage assets across both the US and the UK. We'll look at what makes a US citizen different. And that really sort of ties into the reporting obligations. Of course, the big thing for US citizens is the fact that your citizenship, whether that's from birth, whether you have picked up a green card over time, or if you have a substantial presence in the US, you are considered a US taxpayer in the eyes of the IRS. And what does that bring with it? What challenges does that bring with it? And also the reporting obligations. Um, we will spend most of the session today really looking at how to invest tax efficiently for US taxpayers in the UK. Of course, this is a big uh, portion of what we actually do in our day-to-day work. And so we really wanted to start to really break this down into piece by piece to make sure you're aware of some of the big landmines to avoid, but also some of the opportunities that you have um, when it comes to investing in financial planning. We'll touch on things like the custody of assets and why it is that we typically recommend that US custody assets is the way forward. And then we'll also finish on some questions. What I will say though is with regards to the questions, um, we've done a number of these presentations. And what we often find is actually asking questions as we go is going to get whoever's listening the best out of this actual presentation. And so please don't hesitate to put the hand up, flag, or just actually, Todd, I'm not sure if they can come off mute, but if Todd's able to just flag to me if we have any questions as we go through the presentation today, I'll be more than happy to sort of answer them as we go. Um, Without further ado, Maseko. This is really just, as I said, to just provide a little bit of perspective on who you're actually listening today. Um, But we are essentially a specialist US UK wealth manager that really focuses on anyone with any type of US connection. So that could be Americans that have moved to the UK, that could be Brits that have moved to the States, or really anyone with assets in either jurisdiction. And the reason we are able to advise clients in those circumstances is because we are registered with the SEC in the States and then regulated here in the UK by the FCA, which puts us in a pretty neat position in order to help service that particular niche. In terms of just some quick high-level details, so the firm was founded back in 2008, really with the specific intention of helping Americans here in the UK. We've grown up a lot since then. We're now managing just shy of 4 billion of assets under management. And the service offering that we provide, as I said, is really anyone with a US connection now. We've broadened our horizons in that sense. Along the way, we've won a few awards, and we now have 120 staff dedicated to this US UK connected community, which in actual fact puts us as the largest player in terms of the space dedicated to this particular niche in terms of bodies. What do we do? What is it that we do? Really, our core focus will be broken down into three key pillars. The first one is investment management. So this is helping clients invest their assets, making sure first and foremost they are tax efficient from both a US and a UK perspective, but are also in line with their goals, their objectives, their suitability assessments. That's pillar one, is the investment management side. The second pillar is really the financial planning aspect. We're very much a planning-led firm here, at Mosaico. And so what we do is holistic advice, holistic financial planning, looking at everything from detailed cash flow modeling, scenario analysis, looking at someone's wealth holistically. And so really focusing on the sort of the broader aspects of someone's wealth and helping along the planning side of things. And then the last one is really the relationship management. So what I should caveat at the start of this call is we are not a tax accountants. We are not a lawyers. That said, we have to be tax aware and we have to be aware of the legal interplay between the two jurisdictions in order to do our job properly. And so what we do is that we actually work alongside specialized US UK tax accountants and lawyers in order to provide holistic service for our clients. Very, very briefly, just in terms of the sort of the figures around who that we actually serve in terms of the client base. So you can see there at the top, the vast majority of our clients are here in the UK. The age range is from sort of 18 up to 71 plus. So you can see that there. But the vast majority sort of falling in within the sort of the 51 to 70 mark. But that 27% figure for the 31s to 50 owners is growing, as is the sort of the 18 to 30 range. And then what you can see there at the bottom in terms of the citizenship, as you can imagine, the vast majority of our client bases are US citizens. But that's not to say we don't have non-US citizen clients, whether that's someone's a non-American spouse or just UK only clients. We can deal with a broad variety of situations. Now, what are some of the challenges of being a US taxpayer? Now, as I mentioned at sort of the start of the call there, this really stems from the fact that with a US citizen, if you've got a green card, if you pass a substantial presence test in the US, the IRS is going to consider you a US taxpayer. And on doing so, will look to tax your global income and gains. That will come into scope of taxes for the IRS's perspective. And so when you actually move outside of the US, you're not just dealing with the IRS, you're then dealing with whichever jurisdiction you then move to. And so you're managing between the two different jurisdictions. This becomes even more complicated when you're dealing with different currencies. If you're dealing with different tax years, which is the case between sort of the US and the UK, UK, of course, being an April to April calendar year basis, whereas in the US, this is, April to April tax year, whereas in the US, of course, it's a calendar year basis. Little things like that can really provide opportunity to trip up. And so really trying to manage that is extremely important for our client base. Including with that, it's really the complexities around reporting requirements. and the issues with not going ahead and actually making the sufficient reports, making sure you're filing correctly for filing in the right tax years, not completing your FBAR forms, which we'll come on to in a moment, and things like that, along with the investment considerations. As I said, we need to be making sure that any investments that are made when you have an American here in the UK, they have to be tax efficient from both a US and UK perspective. So we'll spend a lot of the session going through this today. In terms of just, this is really just looking at a very sort of a brief recap on the history, but in terms of Mosaico, as I said earlier, we've been going since 2008. The founders were already working with the US expat community at Citigroup. And at the time, there was some big landscape changes really going on back in 2008. There were changes to how non-domiciled individuals were taxed here in the UK, which of course is very topical considering that the non-dom regime has just been abolished in the recent UK autumn budget. The FATCA reporting was on the horizon at this point. And in 2008, this was really at a time when everyone was de-risking after the great financial crisis and actually looking to remove US citizens from their books because of all of the additional reporting requirements that comes with that. And so really it was a perfect storm for a firm like Mosaico to be founded. And so that is what we've been focusing on ever since. We are dedicated to this. And then lastly, that's just noting there in terms of where we're registered by the SEC and then regulated by the FCA, as mentioned before. In terms of what actually makes a US citizen different, though, this is really, as I mentioned before, it's very unique to the US. Having a citizenship-based system that follows you around the world, regardless of where you reside. And so making sure that you are filing your annual US tax returns, paying any US taxes due is going to be the same case as if you was a US resident, but it's ensuring that you do that correctly. Likewise, we'll come onto it in a moment in terms of some of the forms that you need to file. One noted here is, for example, the FBAR form, or the report of foreign bank and financial accounts. You may see this referred to as sort of a FinCEN report 114, but that's a little bit of a mouthful. And essentially, this is a form that anyone with essentially financial interests or signatory powers of any account outside of the US, so think about any bank accounts that you have in the UK, think about any investment accounts here, they need to be reported each year when you come to file your US tax returns. If you are able to report it, there's not going to be any fines. It's literally just a reporting obligation. But you can see there at the bottom, for those that don't file those forms, that fail to report those accounts, there are penalties which can essentially be up to 50% of the account within the amount within the account. And so you want to just make sure that first and foremost, you're reporting what you need to report. FATCA. You may have heard, again, this is another acronym, and there's plenty of them in this space. FATCA reporting stands for the Foreign Account Tax Compliance Act. And really, this was a law that was enforced to try and claw back some of the untaxed income and gains that US taxpayers that were living outside of the US were benefiting from. Having accounts that were held offshore and out of the grasp of the IRS, they essentially looked at it and said there is millions and millions and millions of tax revenue that the IRS is actually losing out on. And FINRA was an actual, it was an enforced act to try and claw back some of that. And really what it done is it actually put the onus on not just the individuals themselves, but also the institutions in which have hold those the US clients' assets. And this really is where it's then where a number of Americans here in the UK come to a firm like Mosaico and say, I just can't, no one seems to want to work with me. I'm an American, I'm a US taxpayer. They found out about my citizenship and they said, no, sorry, we can't help you. And it's for these reasons. The onus is on the firms and you need to be registered and regulated in the correct way in order to do what we do here at Mosaico. I'll just pause there before we move on. Okay, we've got some questions here, just making sure that we are.
We do have a question here, Daniel. It's
perfect.
What defines a foreign bank account? I have a Revolut account and now a Wise account, but attached to my US address.
Yes, so great question there, and it'll be based on, and again, the two references you made there makes it slightly harder because I know Wise, as an example, you can have US accounts with Wise that are in the eyes of the IRS where they will be deemed to sort of be US based, but you can also have UK accounts as well with Wise, as an example. Likewise with Revolut, if it is considered a UK regulated firm, my understanding is that that should be filed on an FBAR. If it is an account held outside of the US, it should be on the FBAR form. And again, as I said, it's just a reporting obligation that you just need to say, this is the account I've got outside of the US. If on any day that the amount within that account exceeds the $10,000 threshold, then you just need to report on that. And again, with these types of conversations, if you are working with a US UK accountant, this should be just run of the mill. This is just part of that process, which we'll come on to in a moment about some of the things that you can be doing to help you be tax efficient from both a US and UK perspective. But my understanding would be that if there's an account here in the UK, it's got sterling assets in it, it would be likely that it needs to be filed on an FBAR. I hope that helps answer the question. Right then. As I mentioned before, this is really what we want to spend most of the session today. And it's some of these basic do's and don'ts for US taxpayers in the UK, especially when it comes to things like investments, and especially when it comes to things like financial planning. What I will say is this is very much an introductory call today, as I said at the sort of the top of the call. What we will be looking to do in our next session, which we've actually got penciled in for December time, is to actually go into some of these details and some of the different account types, some of the different asset classes into a little bit more detail. But today is really to just give you a broad lay of the land. So we'll go through this relatively slowly. We can answer questions along the way. But really, as I said, we will be doing more sessions like this to really sort of dig into some of the details, and also more to do with specific questions and specific needs. But for now, what I wanted to do was to introduce you to a couple of acronyms that you may have come across in the past, and this is what you don't want to do from the perspective of being a US taxpayer here in the UK. The first one is what you want to avoid: passive foreign investment companies, or PFICs is what most people know them as. And essentially, these are pooled investments. These are collectives that are held outside of the US. So think of it from it's to say it's a UK fund. It might be a unit trust here in the UK. It might be an open-ended investment company here in the UK. It might be a CCAV in Europe. Essentially, these are pooled investments. They're structures that are held outside of the US, they're being foreign. Now, the issue with holding passive foreign investment companies is that when you, as an American, come to sell those assets, if you have made a gain on those assets, the IRS will not look to tax you at capital gains tax rates, which go up to 20% in the US. They will look to charge you at your highest marginal income tax rate of up to 37%. So you're paying almost double the tax when you're investing in passive foreign investment companies. Not only that, the IRS will look at how long you have actually held that asset. And for every year in which you have not paid any of the income taxes due that have been sort of wrapped up within the firm, they will charge you interest and they will charge you penalties for every year in which you have not done so. And so there are situations, they are rare, but we have seen them, when 100% of the taxable gain can get completely wiped out to tax. And so if you take anything away from this call, it's to avoid passive foreign investment companies like the plague. We want to try and avoid those. Not only that, is there's reporting obligations. Tax accountants will charge 150, 200 pound per PFIC, per holding. So again, it becomes very, very costly to hold these within your investments. The word of warning, and I'll come on to this in a moment, but when you are typically working with a UK-based wealth manager, that doesn't understand the implications from a US perspective, what we often find is that they're invested in PFICs. As an example, you work with a UK wealth manager, they want to get the diversification benefits through funds. And so they put you in funds that are domiciled in Ireland, funds that are domiciled in Luxembourg, whatever they may be, they are held outside of the US. And so they are very, very likely to be considered passive foreign investment companies from a US perspective. And so we want to avoid those like the plague. Now, on the other side of the Atlantic, and so we're thinking from HMRC's perspective here now, what we also want to try and avoid for Americans here in the UK is non-reporting funds. And the reason for that is they attract OIG tax treatment or offshore income gains. Now, to give you an understanding about what reporting, sort of difference between a non-reporting fund and a reporting fund is essentially a reporting fund, the investor is liable for any of the tax on the income, whether it's paid out to them or if it's reinvested into the fund. There are other sort of categorizations, but that's essentially it. But the way that they're taxed is different. For reporting funds, so UK reporting funds, they will get any gains will get taxed at 20% capital gains. Oh, sorry, that's now moved up to 24% capital gains tax rates here in the UK. Whereas non-reporting funds, you will get taxed at your highest marginal income tax rate. So again, in the UK, that could be up to 45% on any of those gains. So more than double the tax. Thankfully, there's none of the interest and penalties that come with the PFICs. But again, when you are building a client's portfolio, what you want to ensure is that you are tax efficient from both a US and a UK perspective. And the way you do that is by avoiding passive foreign investment companies and avoiding non-reporting funds. Is that a question there?
We've got another question, Dan. It's how do you know if you have a non-reporting fund?
Great question. So there is actually a list on HMRC's website. You could Google it now, HMRC reporting funds. And essentially that will list out every single reporting fund available. Now, for someone in your position, if you are a US taxpayer here in the UK, what you want to ensure is that you are also investing in US funds, which make them tax efficient from a US perspective. As we said, we want to invest in US funds because that doesn't fall foul of the PFIC regime. So you're investing in US funds, and then to have them with UK reporting status means that they're tax efficient from both jurisdictions. And so when you look on the HMRC reporting funds register, what you will see is a list of funds, as I just mentioned. You can filter. There is a sort of a column which lists ISIN, which is essentially a trading identifier. And you want to see that the ISIN starts with US, meaning that it's a US fund. And then you would look towards the end of the table and it will give you a list of all of the dates and whether it falls on as a reporting fund or not. If it's not on that list, then the likelihood is that it's not going to be considered a reporting fund. But if you do have any other questions and things like that, please don't hesitate to just get in touch. That is such a quick and easy one for Oliver, for George, myself to just help you with. So any questions like that or sort of things along those lines, please don't hesitate to get in touch and we'll share our sort of our contact details at the end of the call. But hopefully that's answered that there. The other thing to note about sort of the reporting funds register, though, is to be aware that funds can fall on and off. They can fall on and off that register. And so it's keeping up to date, which is, of course, what our investment management team do here to ensure that they are going to be considered a reporting fund. Hopefully that's answered some of the questions there in terms of investing tax efficiently, what we want to try and avoid. And we'll dig into some of the details going forward. But the next one, of course, is just seeking advice. We have so many situations where clients come to us and they haven't received advice and they have been here in the UK for a number of years and they come to us and they've either just been hit with a massive tax bill or they know they haven't got invested because they know they just want to put their head in the sand because they know there is so many landmines that they can step on. And the issue with that is, of course, not receiving the correct advice or not just having a conversation like this and just being aware of these issues can be completely destructive to someone's wealth further down the line. As a prime example of this, in that sort of the next point there, Things like investing blindly into vanilla UK investment vehicles. ISAs are a prime example of this. From a UK perspective, ISAs are fantastic. Individual savings account. You've got £20,000 contributions for the year. They go tax-free, no tax to pay when you sort of take distributions out of the account. Fantastic from a UK perspective. The issue, though, however, is actually a UK product. The IRS doesn't recognize the ISA wrapper. And so what they will do is they will look through the wrapper as if it's any other taxable investment and look at the underlying holdings within that account. And lo and behold, if you are working with a UK wealth manager or you are working on a UK platform, the likelihood that you are investing in European funds or, as we said earlier, sort of sterling funds, European funds, is highly likely, and they are going to be considered passive foreign investment companies. And so there's situations where all you needed is a quick half an hour call to be like, what can I and can't I do from a UK perspective or a US perspective? And that could be completely avoided. So seeking proper advice is always a good place to start. We also note in terms of receiving advice from tax accountants, just making sure that instead of just having someone that's doing your US taxes and then you're just filing here on sort of PAYE, you're just doing it through sort of your employment income. If your situation is slightly more complex and you've got investments in there or you've got structures or you've got things like this, what we would often recommend, almost always recommend, is to have someone that understands the US and UK interplay. So actually working with a specialist US UK accountant that understands that in order to receive things like in order to get credits for any UK taxes paid, you want to prepay your UK taxes by the 31st of December each year in order to get the aligning credits from a US perspective and not just paying your UK taxes in sort of the 31st of January where most people have to. It's little things like that which are sort of part and parcel of our day jobs, but really you need to understand that and to be working alongside a specialist who can sort of put you make sure you're structured correctly in that sense. Just to sort of to follow on in terms of the sort of the vanilla UK investment vehicles. Oh, I think we've got another question there.
The next question is, could you elaborate on the workplace pensions instead of just ISAs, for example? Is there a correct way to report pensions equivalent of how we report 401k contributions? And then I'll go on to the next stages of the question.
So the pensions, we can come on to that. I've got a whole sort of slide actually regarding those. The things with pensions, based on my understanding as a non-tax professional, is that the vast majority of the US UK tax community will view pensions as pensions in both jurisdictions. And so your 401ks in the US, your traditional IRAs, your Roth IRA are considered a pension both in the US and in the UK. Likewise with your UK pensions here, or if you've set up a self-invested pension plan, a SIP, they are going to be considered pension assets in either jurisdiction. You're still benefiting from the tax-deferred growth within those accounts. And it's only really then for things like your traditional IRA, your 401k, or your UK pensions here, if you've already taken sort of your 25% tax-free lump sum, the distributions will then be taxable. But the underlying investments, where they are considered in that sort of tax-deferred wrapper, you don't have to be as conscious about the underlying investments. But again, I'll come on to this in a moment because I'll go into a little bit more detail. Hopefully that answered a part of that question, but we'll certainly come back to it when we get onto there. Was the next part of that question sort of useful to note here, or?
The next part of the question is about 401 contribution amounts, as they're smaller than workplace pensions. How does that work? And the other part I'm sure we'll come on to soon, which is there a way to move a pension to a 401k if we're leaving the UK?
Perfect questions. So again, this is all based on my understanding as a non-tax professional. Typically, if you're an American that has moved over to here in the UK, the vast majority of our clients are essentially stopping their contributions to a 401k and then just starting their contributions to a UK pension. That said, that comes with a caveat, because the reason that is often the case is because you have to essentially earn more than what is the foreign earned income exclusion to be able to actually contribute to a US pension whilst you're outside of the US. And the reason for that is because you need to be deemed to have US earned income. And so for those that are earning, I believe the figure now for 2024 is $126,000. If you are electing to be taxed, if you are electing to be included on the foreign earned income exclusion, you wouldn't be deemed to have sort of US earned income, and so you then wouldn't be able to make contributions into your 401ks or into your traditional IRAs, your Roth IRAs. But again, that'll be very dependent on the client's circumstances. Was there another part to that? It was the
other part was about is there a way to move a pension to a 401k if we leave the UK?
So unfortunately not. The issue with pensions is that you can't port pensions typically. And so what I mean by that is once you have built up sort of pension assets here in the UK, unless you actually take a distribution from that pension and move it into a taxable environment, you can't actually move those assets. And in reality, you shouldn't want to or need to. And the reason for that is, as I mentioned earlier, the US and the UK have a tax treaty in place, which means that they recognize pensions in both jurisdictions. And so even if you were to move back to the US and you still have pension assets here in the UK, you can still benefit from the tax deferred growth within that account. And so, of course, when you are managing clients' money, what you're often trying to do is to maximize the money that you have in tax deferred accounts like your pensions and not actually taking it out into a taxable environment where you're going to then be taxed on any of the income and gains over time. And so typically what we recommend, and again, I'll come onto this when we get to that point in time, for our client base, where they have been here in the UK, they have worked a number of years and they built up pension savings in the UK, what we typically recommend is that they transfer the workplace pension into a SIPP, and then with the SIPP wrapper, again, that is still considered by the vast majority of the tax community as a UK qualifying pension. The benefit with that sense is that you maintain the tax deferred nature of those assets within the wrapper. What you also do is you expand the investable universe about what you can actually invest in within that pension wrapper. So once you've moved it from your workplace pension, which is typically going to allow you to invest in a number of sort of predefined funds, you move it into a SIPP where you increase the investable options available to you. And then for our client base, where we work with UK pension providers that allow us to custody the underlying investments in the US, we would then look ahead to go ahead and do that. So a number of our clients will have UK SIPPs here. So it's a UK pension, but the underlying custody of those assets is on a US custody platform invested in US funds, globally diversified, but in US funds. And so they are aligned to the spending currency once you move back to the US. But I'll pause there because I'm conscious of time, and our next session in December will be going into a lot more detail about pensions, because that is, of course, where we get a lot of questions there. But hopefully that helped answer the question there. But as I said, pensions is something we'll be going on to in the next session. Likewise with things like property. Right, I'm conscious of time, so I want to make sure that we're ticking on here. Some of the do's. Sorry, just to finish off this point here. So investment bonds, again, very common planning tool from a UK perspective. The issue with the structure, they're set up via an insurance company, and so in the eyes of the IRS, they will deem those passive foreign investment companies and look to tax any of those gains unfavorably. Likewise with EIS and VCTs. EIS, and I should have sort of explained that on there what that stands for, is Enterprise Investment Schemes, and then VCTs are Venture Capital Trusts. Again, very common planning tools from a UK perspective, but in the eyes of the IRS, these are funds that are held outside of the US, and so they're going to be considered passive foreign investment companies. In terms of the do's, so we've touched base on a few of these here. Of course, the first point is actually just seeking professional advice that actually understands both jurisdictions, whether it's us at Mosaico, whether it's a tax accountant that we can put you in touch with, whether it's a lawyer. That is usually the first place to start, to say, this is my situation. What do I need to be aware of? Do I need to restructure anything to make sure that going forward, I'm tax efficient from a US and UK perspective? I touched on this one after as well, is sort of remembering to file your US tax returns and your UK tax returns. And it's often the case that for the vast majority of clients, prepaying some of your UK taxes to make sure that they're aligned to the US tax year again, often means that you can get those offsetting credits in both jurisdictions. Understanding the impact of what is deemed clean capital or mixed funds. We will be spending more time on this as sort of a deeper dive into our next session. But if anyone has any questions around sort of clean capital and mixed funds, don't hesitate to get in touch. This has all changed over the last, well, what are we now? The last 12 days or so. So in terms of how non-DOMs were actually taxed here in the UK, there has been a significant change to that based on the latest budget that we had here. And so the latest regime that we are currently in is being abolished essentially from April 2025. So again, we will spend a little bit more time on that going forward. In terms of understanding how gift and inheritance tax rules for US persons, so this is, I know we had a couple of questions in the lead up to this call, so I'll just sort of give you a very quick rundown of this now. So for those of you that don't know, in terms of the interplay between sort of the US gift and estate threshold and then what you have here in the UK, essentially in the US, throughout your lifetime or upon death, you can gift essentially $13.64 million without your estate becoming subject to inheritance tax at 40%. You compare that to how the inheritance tax rules work in the UK, whereby everyone will have a £325,000 nil rate band, and then some individuals, if their estate is less is worth less than £2 million, they may also get an additional £175,000 for their main residency. Anything above that amount will be taxed at 40%. And so you can see a stark contrast between 13.64 million in the US and then up to £500,000 here in the UK. And so for us in our day job, it is really looking to manage across the two jurisdictions. For in the UK, because of course this one takes a little bit more management, to be honest, what you can do though is you can make transfers in your lifetime. What they're referred to as is potentially exempt transfers. And essentially what this means is you can gift assets, and if you survive that gift by 7 years, you will not be subject to UK inheritance tax on those gifts. They will actually move outside of your estate. And so for the planning perspective, that is what we look to do for our clients. We can manage it from a US perspective in terms of the lifetime gifts, but really in terms of the actual valuations we're talking about here, it's really the UK management that takes a little bit more thought to it. The last point there is just noting, and sort of is aligned to that, is preparing to become long-term resident in the UK. Now, this what long-term resident is essentially a new term for what was once known to be sort of deemed domicile in the UK. And just as a very brief recap on this, so the current rules around this are the fact that in the UK, you have the option to be taxed on something called the remittance basis of taxation within the first 7 UK tax years after you arrive. Essentially, what this means is that the HMRC will not look to tax you on any of your foreign assets or foreign gains unless you remit those into the UK, or you physically bring them into the UK. And then, of course, they'll tax you on whatever you earn here through sort of your employment income, or if you've got rental properties here in the UK. That's the current rules. You've got the first 7 UK tax years sort of as a freebie. You still have to sort of report on it. But from 7 to 15, most individuals will then begin to be taxed on something called the arising basis of taxation, whereby their global income and gains will come into scope of come into UK taxes. And so it's making sure that you've got your portfolio is actually structured in a way that's tax efficient from both jurisdictions. The last milestone under the current regime is that if you have been in the UK for 15 of the last 20 UK tax years, you would then be considered something called deemed domicile in the UK. And essentially what that means is once you have hit that threshold, your global estate will come into scope of UK inheritance tax. And so what we had to typically do was plan ahead before you actually sort of you got to that threshold. As I mentioned, in the latest budget, the current regime has been abolished. We no longer have sort of the remittance basis of taxation. Instead, now we've got a new regime called the FIG regime, foreign income and gains regime, essentially. And the long-term residence is regarding the sort of the 10-year tail. So if you've been here as a long-term resident in the UK for 10 years, then again, your global income and gains will come into scope for UK inheritance tax. But there's lots more that we could cover on that particular topic. And so we'll park that for today. And that will certainly be something that we will look to go into more detail in our next session. But again, if anyone has any questions around this, then don't hesitate to get in touch. I'm conscious of time and I want to make sure we've got enough for questions at the end. But really, how do we then invest tax efficiently as a US taxpayer in the UK? And I wanted to just break down a few sort of broad asset classes and types, just so we can sort of set the scene, as we said, and we can dig into a few of these in more detail as we go forward. But cash, we often get conversations or sort of questions around cash. Can I hold cash? Is it going to be a problem? The vast majority, if it is just held as physical cash, that's not going to be a problem at all. If you've got sterling in a UK bank account, it's not an issue. The ones you need to be aware of, though, is money market funds. So again, think about this. So if money market funds are a very, very common sort of tool in the US, they are considered sort of cash equivalent. So if you've got US accounts, and this is thinking in a taxable environment now, this isn't thinking about what you've got in your 401ks or your IRAs or Roth IRAs. This is talking about in a taxable environment, just your everyday brokerage accounts. What you want to make sure is if you have money market funds, to be aware that there is a potential for a currency gain to be taxed at income tax rates in the UK. And the reason for that is, again, think about it, the term is in the name. It's a money market fund. And so HMRC will look at that, and the vast majority of money market funds are going to be considered non-reporting funds. And so you need to be aware of that, because once you actually take money out of that fund, what they will look to do is look at how much you actually put in there in terms of a sterling amount. And then if currencies have fluctuated over time and you are now taking out what is deemed to be more in terms of UK cash, they're looking at that basis, they will actually look to tax you on that currency gain at income tax rates in the UK. And so again, just something to be really aware of. Although the US thinks of it as just another cash equivalent, the term money market fund means we need to be aware of it from a UK perspective. So that's just one to note there. Cash ISAs. Again, as we said, sort of a couple of slides back, ISAs are just considered a taxable investment account from a US perspective. And so although you're sheltered from the tax from a UK perspective, the interest within that is going to be taxable from a US perspective. Likewise with quasi cash, so sort of premium bonds, the income is taxable from a US perspective. Now, as we said, what we want to try to avoid is passive foreign investment companies from a US perspective and non-reporting funds from a UK perspective, because we don't want to get that offshore income gain tax treatment. And so how can we invest? There's two ways you invest tax efficiently as an American here in the UK. The first one is avoid funds. Invest in single stocks, single bonds, single live securities, because there are no PFIC issues because you're not in funds from a US perspective. And there's no IAG issues because you're not in funds from a UK perspective. It's single line security. So they will be deemed tax efficient from both the US and UK perspective. Of course, the issue of those is the concentration risk. The fact that you would need to pick the stocks, whatever stocks you're holding, whatever bonds you're holding. And of course, the ability to do so is very difficult. If you actually look at any of the research around picking individual stocks and bonds, what you see is in being able to actually outperform a benchmark consistently over time is very, very difficult to do. The probability of doing so is very low. And you also see things like, as we said, concentration risk there. It's actually picking a number of different funds. You may have a danger of sort of a home country bias and not actually getting the diversification benefits that you do with funds. And so although it will be tax efficient, that's not how we allocate on behalf of our clients. Instead, what we look to do is invest, as I said earlier, with US funds with UK reporting status. Now, the reason that this is our approach is because first and foremost, it's tax efficient. We're investing in US funds. So as we said, these are funds sort of set up in the US, domiciled in the US. And so the IRS is happy. We're not investing in foreign funds. We're investing in US funds. And then HMRC is also happy because we're investing in funds that have UK reporting status. And what that means is that we can get capital gains tax treatment in both jurisdictions. Not only that, we get the diversification benefits. You get the diversification benefits of funds. Of course, we have evolved now, and the evolution of capital markets away from just picking individual stocks into now US mutual funds that have UK reporting status, exchange traded funds as well. And so that is typically how we recommend and how we invest on behalf of our clients. As you can see there, just a couple of the points here. So you can have them hedged to sort of dollars or sterling, less tax or the compliance costs that come associated with invested in, firstly, inefficient funds. If you are in those if you're in sort of UK structures or European funds and things like that, you've got the capital gains tax treatment in both jurisdictions as mentioned. You can use your CGT allowance depending on how you're actually filing in the UK. These are funds that could be tax managed, again, which is a number of our sort of funds within our allocations, and they're cost effective. And so really that is how we structure our clients' portfolios. Real property, conscious we've got 10 minutes to go. As I said, we will cover this in more detail in our next session, but just quickly just to go around the question of property, because I know people had questions on this. So yes, you can purchase property here in the UK. It can provide a yield if you are renting it out. You just need to make sure that you are paying any UK taxes due, but also making sure you're getting the aligning credits from a US perspective. And so any of that rental income, you just want to make sure you're paying the taxes as appropriate. And the difference here in the UK, which sort of combines the two of the sort of point 2 and 3, is based on my, again, this is our understanding as a non-tax professional. If you have a primary residence here in the UK, any gains, if you was to sell that asset and it's your primary residence, there will be no capital gains tax to pay. Which, if you compare that to the US, where most people, well, in the US, if you're a US taxpayer, the IRS will essentially give you $250,000 as a main residence sort of excess. Anything above that amount in terms of gains will be subject to capital gains tax in the US. And so that's just one to be aware of there. And sort of the popular example is sort of Boris Johnson selling property and him being sort of an accidental American and having to pay US taxes. But that's something to be aware of from a UK perspective. You can get the primary residence relief and have to pay no capital gains tax from a UK perspective if it's your main residence. If it's a rental property and you sell that, then yes, there'll be capital gains tax to pay in that perspective. But from a US perspective, even if you used to sell sort of a US property, it's very much sort of anything above that amount is 250. Anything above the 250,000 threshold, you look to be subject to US taxes on that. I know there was a question around. Was you about to ask something there, Oliver?
Yes, we've got a quick question here, very good question. And you've caveated earlier that we're not tax advisors. But to your understanding, the question is, how is rental income from properties in the US treated by HMRC?
So great question, and that'll be dependent on how you're actually reporting your global income and gains. If you are someone that is paying tax on the arising basis of taxation, you will then have to be subject to sort of income taxes on that. Whereas if you are someone that has been here under the current regime for less than 7 years and you're able to get taxed on a remittance basis of taxation, any of your foreign income and gains doesn't have to come into scope of UK taxes, and so you just have to pay it in the US. The issue is if you then you move on to the arising basis of taxation, and then you're paying tax on your sort of global income and gains, that will come into scope of UK taxes as well. The important point to note, though, is again, if you are filing your taxes correctly, the US will have primary taxing right because it's a US situs asset. But what you should be able to do is get a credit for any of your US taxes paid. And so what you want to try and avoid, like with any income or gains, is you want to avoid paying double the tax. If you're already paying it in the US, which you will do anyway because it's a US situs asset and you're an American or US taxpayer, sorry. So you just want to make sure you're aligning the credits there. Hopefully that helped.
That's great. And then we have another couple of questions, but as we're on property topic, we'll come back to them.
Perfect. And just the last couple of points here, and last couple of points here. So, of course, people ask the question all the time: is property a good investment? And the answer is it can be. It can be a good investment. It's diversified from your investment accounts and sort of and things like that. The issue with it, though, of course, is illiquid. It's hard to devise. You can't spend a property in the shops, and so it's making sure that you are diversified in terms of your asset base and making sure that you have sufficient liquid assets, whether that's in your pension accounts, whether it's in taxable accounts, or whether it's sufficient cash holdings, to make sure that you can facilitate your day-to-day spending. Just in the UK, again, just noting here, of course, transaction costs are quite high here. There's stamp duty, land tax to pay on property purchases, state agency fees and things like that. And then the last one, this is a point we will certainly cover in more detail in the next session. But when borrowing UK assets to fund a UK property purchase, what you need to be aware of is essentially what that looks like in terms of US, what you're actually borrowing in US terms. So as an example of this, say on day one, you borrowed £1 million, and let's just for ease, sterling and dollars was 1-to-1. And so you'd borrowed $1 million at that point in time. When you actually come to pay off that property, whether or not you're sort of moving to a large property or if you're coming to sort of remortgage the property, whatever you are paying back, the IRS will look at what you are actually paying back in terms of dollar terms. So say you borrowed the $1 million in the eyes of the IRS, but you're only paying back $900,000 based on how the FX rate has moved. What they will do is they will look at that and say, hang on a minute, you've made a gain on that. And they will look to charge you taxes, not capital gains tax charges. They will look to charge you income tax rates on that phantom currency gain. And so again, this is something that sometimes is unavoidable, but it's just something to be aware of when it comes to actually borrowing to fund a sort of a UK property purchase. There are some planning opportunities around it, whether or not if you're in a mixed nationality couple, maybe you'll have someone else borrow, sort of the non-US partner borrowing the money. And again, there's other sort of ways that you can think around this, but we'll certainly spend some more time on that in the next session. Conscious we've got 5 minutes to go. Again, retirement accounts, this is what we're also going to be spending a lot of time on in the next session. But as I said, UK occupational and personal pensions are typically deemed to be okay. Where you have the US-UK tax treaty and where they are, the vast majority of the tax community will consider pensions in either jurisdiction to be pensions. It means you are benefiting from sort of the tax deferred growth within those accounts. And so it's just noting down here in terms of sort of funding a UK SIPP, you're getting sort of the annual contributions you can make. You can also make catch-up contributions. This is limited to the amount you're actually bringing in terms of your earned income in the UK, but you can make some significant contributions in one go. As we said, tax deferred until withdrawal. This is an important point to note and coming back to the question earlier about if you were to retire in the US, what planning opportunities can you do when you have UK pensions that you don't want to take a distribution from and bring those assets into a taxable environment? How can you manage that pension going forward to make sure you're benefiting from the tax deferred growth, but also the fact that you are moving back to the US? And so, as I said, working with someone like Mosaico and the pension providers that we work with, what we can do is custody the underlying assets in the US. And so the underlying investments are aligned to your spending currency. But not only that, there is a process that you can go through when you actually look to take distributions from that account, which can essentially mean that you're paying any of the distributions tax-free from a UK perspective, which of course is a benefit because in the UK you can get up to the 45% tax rate after like £125,000 worth of income in the UK, whereas before you hit the highest tax rate in the US is over like $400,000. And so the benefit of actually getting your pension distributions paid gross from a UK perspective is quite a powerful piece of planning. And so we help clients sort of go through that. In terms of the UK recognising IRAs, as I just mentioned there, that is the case. This one, the next bit is looking at sort of 401ks and the planning opportunity. if you have foreign source contributions to your US retirement accounts, whether or not you're on a US contract, as an example, we often see this, or you're making contributions whilst you're here in the UK, there's a really useful piece of planning that you can do with regards to any sort of excess foreign tax credits that you have, which actually allows you to make contributions into a Roth IRA, which is, of course, a tax-free account. These are usually funded by after-tax dollars. And what you can do is you make those contributions. You can use your excess foreign tax credits from any of those sort of additional UK taxes that you paid. And it's a really sort of smart planning tool to actually get it into a sort of Roth IRA. So again, we'll go through that in the next session. And then the last one there is just asset location. So where pensions are considered pensions and tax wrapped, sort of tax wrappers, what you can do is actually hold GBP denominated PFICs in your retirement accounts, which means that they can match your GBP liabilities if you're planning to spend planning to spend your retirement in the UK, as an example. And so that is a sort of a useful thing to note in terms of sort of the GBP pensions. There's just a word of warning there. There are some tax accounts out there. We do know who they are, but some actually do view sort of SIPs as foreign trusts and will actually look at the underlying holdings and actually request PFIC reporting is done on an annual basis, which can get quite expensive. And so just to be aware of that.
And on that, Dan, there is a specific question on that. I think you've covered it very briefly there. And the question is from Sandra Mark, thank you. Is there a list of USA domiciled funds which are available for purchase by individuals via a SIP? They're currently finding it hard to find USA domiciled funds.
Yes, and this is often one of the issues that a number of clients actually come to Mosaico come up to. It's their ability, and it all stems from the fact that UK investment houses or UK wealth managers or UK sort of finance institutions, if they are not set up and they are not registered with the SEC, or they're not able to actually advise US clients or invest in US funds, then they won't actually be able to do so. And so that is why it would be working alongside someone like Mosaico to try and help you actually get those investments made. And again, we can touch base on this in terms of some of those providers out there. But the point of UK sort of SIPs, as an example, is that it should allow you to invest the underlying assets, have a much greater investable universe for those. But you need to be working with the providers that are able to deal with Americans. That's the point. I'm conscious we're at time now. Very quickly, just in terms of sort of key takeaways about the custody of assets. So as I said, the way we structure our clients' portfolios, we invest them in the US, investing in US funds that have UK reporting status. And there are a number of benefits to actually custodying assets in the US. First and foremost, the US is the biggest global economy. And so custody costs are benefiting from the economies of scale, essentially. They're considerably less expensive than sort of UK custody or sort of European custody. Likewise, trading costs are often lower than in the UK, and the actual underlying fund costs, whether it's mutual funds in the US or sort of exchange traded funds, again, the fund costs are also cheaper. So all of these are rationales as to why we actually invest the way that we do on behalf of our clients. You're also benefiting from the protections of sort of, you can see this SIPC and FDIC protections. And one of the other benefits is, of course, with US custody of assets, you're getting your tax forms produced as standard. They're going to be sending through your 1099s each year. You're going to be providing your 1042Ss for your tax filings. There are no FBAR or sort of FATCA reporting that you need to do because they're funds based in the US. They're on sort of US custody platforms. And so you don't have to worry about any of that from a sort of a filing perspective, which is also useful. And then what we do internally is we will provide schedule of activities, which are essentially taking your US assets and then detailing them for the UK tax year. So making sure that when you are going to your tax accountants, you're providing with all of the information that they need in order to do your tax filings properly. And there's just a couple of last ones there in terms of sort of online access, monthly statements, etc. that really takes us up to sort of the hour, and apologies that I'm a few minutes over there. As I said, what we will look to do is, if you do have any other questions, more than happy to set up any calls or just get in touch with us. There's a few here that we didn't get to, but we can certainly get to them in our next call. In terms of sort of the implications of inheritance tax, that one's pretty straightforward to just answer. So the way to think about this is, if you're inheriting money, you are the beneficiary of that money. And so there isn't really anything to consider from a sort of a tax perspective. It'd be the estate in which you are inheriting from. They are the ones that have to deal from the US taxes. The only thing to be considerate of is if you receive assets or funds from sort of American parents, you then just need to be considerate of, well, what are you actually inheriting? If you're inheriting funds, are they tax efficient from a US and UK perspective? Now you're here in the UK. Of course, if they're sizable assets, then they will also then form part of your estate. And so there are planning opportunities to make there. So hopefully that answers that one relatively quickly. Preparing to depart from the UK to the US. So moving back to the US is less of an issue than people moving here to the UK. And the reason I say that is because the tax treatment of Americans here in the UK means that you need to make sure that you are tax efficient from both the US and UK perspective. Of course, the UK has a residency-based income and tax regime. And so if you leave the UK, you then fall out of the UK tax net, so to speak. And so you then just need to be aware of if you've got any other investments that you've maintained here. If you've got bank accounts that have maintained here, you just need to make sure you're still filing those when you get back to the US. Likewise with your pensions, just making sure you're still reporting those, et cetera, et cetera. Just quickly on the next one there, in terms of sort of most tax efficient setup for children, sort of for US, UK households. Of course, junior ISAs, again, are very common planning tools from a UK perspective, £9,000 contributions into it each year. The issue though, however, is of course, they're UK products. And so you just need to be aware of what the underlying assets held within the ISA wrapper are and making sure that they're tax efficient from a US and UK perspective. You will still have to pay any of the sort of the interest or any income or capital gains within the ISA wrapper to the US, but you'll still get sort of the tax-free benefits from a UK. And of course, 529 plans or education plans, these are very, very common in the US, given how expensive it is to actually go to college in the US, which I'm sure all of you are aware. The 529 plans, again, based on our understanding, they are still a useful planning tool. Historically it was sort of US colleges, but now the list of qualifying institutions has increased massively across the globe, and so they're still a useful planning tool. Again, we'll come on to that in the next call as well. But the important thing to know about 529 plans is we typically recommend that the account owner is a US resident person, so it doesn't form part of it wouldn't be considered sort of a trust from a UK perspective. But again, we can have further conversations about that. I noted here just investing in sort of the 401k plans. As I said, we can do that as long as you earn more than the foreign earned income exclusion, and then it will be based on sort of income, what you're actually generating in terms of income for what you can actually make as contributions. And then the last one there, in terms of sort of online systems, this is something that I know a number of clients come up against. The fact that most providers now, they ask for sort of two-factor authentication and how to go about doing this. We've seen this with, and the issue of course, is a number of US custody providers that aren't set up to work with global residents. And so unless you're able to sort of maintain a US phone, that becomes an issue. There are opportunities. Sometimes you can actually call them up and ask for a verbal confirmation to get past the sort of the multi-factor authentication there. That is what we've seen in the past. But I think the important bit is to try and start working with a sort of a custody provider that allows you to be resident outside of the US. And so we typically use someone Pershing as an example. It's the custody administration platform that we typically use for Americans out here in the UK. Right, almost 10 minutes over, so I really do apologize that we've gone a little bit over there. I'll give you just a chance to just, if you did have any other questions, to just take down both George and myself's contact information. Hopefully the QR codes, if you click on that, if you sort of zoom in and go on the QR code, you should be able to just take you directly to either of our sort of contact pages. So I'll give everyone a chance to do that. Before then, really just summarizing to say thank you. Say thank you to Greta, Todd for organising today. Thank you for inviting us in to speak about that. Hopefully that was useful. Hopefully give a sort of a broad lay of the land in terms of some of the tips and tricks you should be aware of as US expats here in the UK. As I said, this is the first of many sessions. Really, we want to build on this and start providing more of these sessions over time. And the next one that I have been referring to consistently through the call is session 2, which is currently scheduled for sort of Wednesday, the 11th of December. And this is going into more detail, specifically sort of about mortgages and pensions, but we'll also touch on some of the other topics that we didn't manage to get to today. So hopefully this has been a nice introduction. It'd be great to see as many of you at that session as well. And then all of that should really set us up quite nicely for an in-person surgery and networking night towards the end of January. So if we don't speak to people in between then, if in terms of quick calls or if you want to get in touch, we will be hosting a sort of an in-person night at our Mosaico offices. And again, it'd be great to see as many of you there as possible.
And Dan, one quick question before we hand back over to Todd and Greta. I did promise an attendee earlier that we'd answer their question towards the end of the call.
Okay.
I'd like to keep my promise on that. I know we can get to all the questions today, but we'll be sure to follow up in our next call. But the question was in regards to Mosaico's minimums, it was stated, do you require clients to hold all of their portfolios with Mosaico? And what are the minimum investable assets required to become a Mosaico client?
Okay, great question. And it's very much, it depends is the answer. So our typical minimum size is $1 million of investable assets with Mosaico. That doesn't mean that you have to have all of your accounts with Mosaico. What we typically do is we will focus on whether it's your pensions, whether or not it's your investment accounts. But as I said earlier, we take a holistic approach to managing someone's wealth. And so although we may not be managing all of the accounts within someone's sort of wealth profile, we like to be up to date and aware of them so we can build them into your cash flow models and so we can build them into sort of our broader plan. But no, we don't have to sort of to help manage all of your accounts. And when I say our typical minimum size is sort of the $1 million mark, again, that's not a hard line in the sand. We can have conversations with clients that are below that threshold. It's more to do with sort of the situation. If we can help those clients, then we will be able to do so. And so even if you fall below that, we are always more than happy to just set up basic do's and don'ts calls, give you a sort of a brief sort of a rundown of how you're currently structured, give some advice around that, or sort of some observations, things like that. But yeah, be more than happy to speak to anyone, really, regardless of sort of account size.
Thank you.
Brilliant.
Greta, Todd, apologies for going over there.
No, thank you. Wonderful. Well, I'll hand it over to Todd. Thank you, everybody, for coming. I really think this is great because a lot of times it's so confusing. It's so difficult. And it's, some of it's tax, some of it's, structuring, someone's investment. So thank you very much, Daniel. Thank you, Oliver. Todd?
Yes, thank you, Daniel and Oliver, for joining us and for staying late with us. And thank you, everyone who's here for staying late. We hope you found this informative and useful. Daniel and George's contact details will be shared in an email to all attendees after the fact. And Oliver, I'll probably slide yours in there too, so don't think you're escaping quite easy.
You're a team, so it'll come through.
As well as they've been alluding to, there's another session on Wednesday, the 11th of December. You will receive a link to register for that session as well in a follow-up email. And finally, I do see that there's quite a few unanswered questions in the Q&A. I've copied all those down and we'll be sending them to the team at Mosaico to either follow up and send me an email with the answers that I can send round, or we can include those at the beginning of our next session. Otherwise, thank you all for joining in. We hope you found it useful, and we hope to see you again at the next one. Until then, enjoy the rest of your evening.
Take care, everyone.
Take care. Have a good evening.